Hello and a very warm welcome on behalf of Angel Academy. I'm Sarah Turner. I'm joined this afternoon by Simon Hopkins and Michelle McQueen, the other members of the Angel Academy team. But we're not alone. We have the support of a very engaged community behind us, made up of an advisory board, our membership, of course, including amongst the members, our deal leads, and also our screeners and sector experts. And last but not least, we have some great sponsors helping us, bringing expertise in law, tax advice and accountancy, talent, marketing and banking. So next slide. It feels like it sometimes, but we don't just run events. We work very hard in the background to build our membership of angel investors, also to attract high quality deal flow, which our investors have come to expect. Those are the investment opportunities. And these come from a wide network and a high profile within the sector. We are in an almost continuous basis screening and selecting opportunities to present to the network at the next event. And as I mentioned before, various of our members take part and help with the screening process. And also we're constantly making investments and we're supporting our member-led investment process. So that means kind of partly communicating the process and helping people run their deal teams, but also kind of encouraging networking between members so that people know who they're investing with, because that's how you build trust in an investor community. So next slide. Our members have invested in 35 startups so far and in more than 50 investment rounds. Collectively, these businesses have raised over £60 million. That's from a mixture of angels, but many have progressed to do VC rounds as well. And between them, they've created hundreds, if not thousands, of high-skilled jobs for both women and men. And many of the businesses that we've invested in are mission as well as profit-driven. You absolutely can do both. We've been running Investor Academy for 6 years as an in-person workshop, and our COVID-inspired pivot is to run these online in shorter versions of what we used to do in person. The overall objectives of the sessions is to clarify what goes on in angel networks, and specifically this angel network. And this session, we're focusing on due diligence. What is it, who does it, and what it involves. Please use the chat button at the bottom of your Zoom window to submit your questions as we go along. And as per tradition with these sessions, we kick off by asking everybody how they're feeling. So let us know in chat on a scale of 1 to 5, where 5 is wildly optimistic. Let us know how you're feeling. Great. Some 5s. Always good to see some 5s. 3-ish, 2, lots of 4s. I think everyone is, yes, good to see some 4. I think somebody's even said 6, so that's Keeffe, right. Excellent. Okay, so moving on with the event. I'm delighted to introduce you to 3 of our members this afternoon, but you might spot that one of them is me, albeit with shorter hair from when this picture was taken. Cynthia, very sadly, is unable to join us. She's got a migraine, and that involves her going to rest in a darkened room for quite a long period of time. So we will bring her onto another event. But for this event, I'm very delighted to introduce you to Kanika and Ros. We have asked each of our speakers to introduce themselves, but also speak for about 5 minutes about one aspect of due diligence. So without further ado, Ros, can you kick off and say a bit about our process at Angel Academy?
I can try and explain it, yes, in simple terms. So hello everybody, I'm Ros Singleton. I am a number of things. I'm the CEO of a fibre to the premises startup called Spring Fibre. So I'm currently armpit deep in fundraising myself. I'm also the chair of something called the UK 5G Advisory Board. And I do a little bit of advisory and non-exec work as well. So I've been with Angel Academy now since I think 2014 or 2015, so quite a while. And I'm invested in a number of businesses. As it says, you know, provenance, applied and higher stakes. My background's largely tech, so I tend to find those slightly more comfortable. But obviously higher stakes isn't the sort of tech I'm used to. And I'm quite invested in nicks and kicks as well, which is actually one of my favorites, mainly because I really actually like the drinks. So the idea is to talk you through the DD process a little bit. One of the things I really enjoy about Angel Academy that gave me a lot of comfort when I started was actually the structure around it, not just in the support from the tax and legal perspective, but also just the fact there was and still is a DD process that we're constantly refining. So it's not something where you have to figure it all out on your own and you just get a pitch deck and a data and you just have to, you know, find your way through it by yourself. The idea is actually that you go through it as a team. So there's a pitch event, and if you see something that you like, you put your hand up virtually or let people know that you're interested. And then what will happen is the deal lead, who are normally assigned at around the pitch event or just before, or Sarah will get in touch with you to explain the kickoff process. And essentially what that is basically the entrepreneur who's leading the deal from the business side will put a data room together for our team to look at. And our deal lead will take things from there, just to enable the entrepreneur to have to deal with one person for questions generally, or a more organized approach rather than just being bombarded all the time. Again, the idea is to make it an efficient and effective process for everyone, you know, ideally with the right outcome. So the deal lead will then pick up and ask people to volunteer. It's great if you do volunteer to do a specific role. You don't have to be perfect or know everything about it. A lot of it is just common sense or knowing where to go for help when you need it. But again, it's not something you necessarily do on your own. We normally do things in pairs, so there's some backup because everybody's busy. And that's the only way actually that we often get from A to B. It's very team focused. There'll be a number of calls with the entrepreneur and the team at the business in question. There'll be calls just within the Angel Academy team looking at due diligence as well, to discuss it and understand questions, thoughts, commitments, and those sorts of things. What is really critical though is very early on we give a soft commitment to the business, because you know, if we're only going to end up investing potentially a small amount, then for them it may not be worth their time and energy to continue to engage with us. You know, equally, if it's going to turn out to be a really big deal, or it looks like it's going to be a really big deal, it's worth being aware of. You know, again, it all just helps the entrepreneur understand what they're doing, and it helps us understand as well, you know, what our contribution is likely to be through the process, and we can work with the entrepreneur to make sure we're fitting in their funding round in the right way. So at this point, you'll tend to be reviewing lots of documents. You might be looking actually at systems, websites, looking into the background of people. There are lots of different tasks that need to be done. And the idea is that ultimately we're coming up to the point we fill in what's called a deal memo, or a deal sheet or a deal note, depending on who you speak to. And it just summarizes all the information. So normally we'll ask people to write down what they've found out in due diligence. And then we sort of have an evidence base that helps as we go through the next fundraising rounds, and also helps us all, you know, have a final review before we do our final commitments, sign documents, you know, hand money over, those sorts of things. So that in a nutshell is it. It is time consuming, but it's also fun and interesting. And I would say that, you know, you have to really contemplate the fact that you're putting your own money into this. And so you always have to be sure that you're doing the right thing yourself, but at the same time, you'll be learning as part of a team. which personally I always enjoy. But that's it really from me.
Right. Thank you, Ros. Okay, I'm up next. So you know me, I'm CEO and co-founder of Angel Academy. My background was in technology and consulting, doing a lot of work in and around startups and around innovation as well, and connecting large corporates to innovative companies. So I'm going to talk a little bit about the areas that we focus on in due diligence. It's not an exhaustive list. It's a list that grows as you kind of gain experience, but some of the main things. I think every experienced investor will tell you that the most important thing is the people. So who's on the team? What sector and startup experience do they have? Have they worked together before? Is a good indicator if they'll be able to stay the course through the trials and tribulations that are coming. We also need to have a look at what hires they might need to make and how realistic those plans are. You might have a look at who the advisors and the board is, if there is one, and also who the other investors, either previous investors, are they following on, or who else might be joining us in the round. You know, everyone always asks me kind of what goes wrong with startups, and I think, you know, usually the issues are with the team. They might not have had all the skills that they needed, or any number of different things. But you know, these are people businesses, even if they're building technology. Product is also vitally important. Kind of, you know, how developed is it? We spend quite a lot of time either using it ourselves if we can, or getting a demo. Another good way of looking at product is to speak to existing customers and hear from them how they're using it, what features they might like to see. On that note, we'll spend some time understanding the product roadmap, and we will also do an assessment of the technology. You know, how scalable is it? It's not uncommon for a team to have just built and then grown a minimum viable product and actually have to start again from scratch. And you know, that might be fine, but they need to know that that's the case, and we need to know. And is there any special IP or know-how in the technology or the science? Another major area to have a look at is the market that this business is intending to operate in. Not only how big it is, we need it to be big, but we need it to be ready and addressable. So who is willing to pay for a product like this? How much are they likely to pay? Who are existing customers? And how do they use the product? How much are they paying? Is it on a monthly recurring basis, which is ideal, or are they one-off product fees? And what does the customer pipeline look like? Are there a large number of customers that they're already discussing who are potentially going to agree to buy the product? Under competition, you know, there's always going to be some sort of competition from any business, and actually having competitors proves that there's a market for in your sector. So actually it's no bad thing, but what you need to tell us is how you're better or cheaper or quicker than the competitors. It's also kind of important to be aware of people who are kind of operating in an adjacent market, who might be able to move into the market that you're operating in, and you know, threats come from nowhere basically. So you know, we need to have an idea of who that might be. It's particularly dangerous when it's a well-funded competitor, Google, Facebook, those sort of things. And you know, then make an assessment on how big a threat competitors are. Financials. So we spend a lot of time reviewing the existing cash position, but also understanding forecasts and financial models, and is the business being realistic about their runway and how far this amount of investment will get them. Also important are the margins on a business. What we want is a high margin businesses. Those are the ones that scale and break even and move to profitability sooner. Valuation. I mean, it's a huge topic in itself. Could probably take days to go through all the different aspects of valuation, but the share price is important. I wouldn't say we're kind of like hugely valuation sensitive at Angel Academy, but it does need to make sense. And I think what founders often forget or don't realize is that actually if they achieve a very high valuation now, then the expectation on them is vast to be able to kind of achieve a higher valuation in the next round, and there will be a next round. It's worth mentioning at this point that we do spend some time reviewing legals, because the terms other than valuation are important as well. So we look at the deal structure. Finally, on my list is what are the key milestones? How far along with those milestones will this particular round get you? When will you likely to raise money again? And is there a path to exit? It seems really early to be having those discussions when you're considering a very young business, but there needs to be some idea, however early stage, and some I think recognition from founders that they'll only see their upside, and will only see an upside as investors if there is an exit. So they need to be focused on that even from the start. So I think that's quite enough. I am now going to hand over to Kanika.
Hi, everyone. I'm Kanika Goela. I have been an angel investor for 4 years. Made my first investment through Angel Academy, and now my angel portfolio spans UK, US, and India. So prior to that, my professional background is financial services, investment banking, and private equity. As a private equity investor, I have done everything from growth stage investing to multi-billion-dollar buyouts across different sectors. So my professional training has been all about process, rigor, and financial analysis, some of which Ros and Sarah covered. So I'm just going to talk about some of my philosophical thoughts as I get into a due diligence process. So first is this concept of investing time before investing money. So for me personally, I like to get actively involved in any due diligence, whether as a deal lead or as a member of a deal team. And I view it as an investment in my education. So even if you come out of the process not having made the investment, you would have still learned a lot. And all those incremental learnings, I think, add up a lot over time and just make you a better investor as you go on. Second is collaboration and leveraging the power of the network. So Ros said we at Angel Academy like to do due diligence as a group. And I'm a big proponent of that because I feel that the whole is more than the sum of parts. And not only is it fun to do it together because it's boring doing it alone, but it's also a very efficient use of our time. There are several areas that all of us look at, and if we kind of divide it up between the group, it's an efficient use of everyone's time. And it's also more effective because everyone contributes their area of expertise as well as their professional networks, which kind of which helps the group make a better decision, hopefully. This third point is, there's no one-size-fits-all formula. So Sarah talked about, all of the things that we look at, but there's no standardized template that you can copy paste and apply to every company. So the kind of questions to ask, the areas to place more importance on when you're doing due diligence, as well as what information you expect back from the founders. It really varies depending on the stage of evolution of the company. So is it really at the idea stage, or is it closer to commercialization? And then the kind of things you look at or the questions you will ask will be fairly different. For me, the two themes that run across any due diligence process is the size of the market opportunity. So what problem is the company trying to solve, and will there be a large enough market for it? And secondly, as Sarah and Ros both said, it's so much about investing in people. The team and people are a very core part of any due diligence process that we do. And I find that more than just the desktop research, you look at the founder's background, you look at their expertise, what they've done professionally, and you get references, but also through the process, how they engage with you, how they answer the questions, how they deal with tough situations, gives you a lot of helpful data points as you make your own evaluation, whether you want to put capital behind backing that particular team. Fourth is this concept that risk is upside as well as downside. So, if you're an angel investor or contemplating angel investing, hopefully all of us know it's a very high risk asset class, and there's very high likelihood of losing all your capital. But there's also potential for making outsized returns, and that's why we do it. I was reading somewhere recently that some of the early angel investors in Deliveroo might make 6,000% on their investment once it IPOs, which is phenomenal. But when you're evaluating an opportunity, there'll always be downside risks, and there'll always be reasons not to do a deal. So you have to take that leap of faith. And what would help you in doing that is if you also ask yourself, if you've identified the risks, what mitigants to those risks could be, and also to push yourself to think of the upside and ask the founders these upside questions, because that's what will help you, make that judgment on, what is the potential upside, and can that kind of balance out the downside risks I might be taking. And the last, it's a very broad point. It's not what you look at it that matters, but it's how you see. So in a group diligence process, I found that everyone will interpret the same set of information very differently, depending again on your own background, your own expertise, etc. And it's very useful to share your interpretation and your viewpoints with the group, because it's as valid as anyone else's opinion. And I think especially if it's different from what most of the group is thinking, do share your viewpoint, air it, because that cognitive diversity does lead to a better thought process in decision making. But equally balance that by the fact, don't get into this tendency of groupthink, which is like, if everyone is doing a deal, don't do it just because everyone is doing it, even when you're not convinced, or don't not do a deal because most of the people have backed out, because ultimately it is about your judgment, and your assessment of whether for you, how you see the future playing out, is balanced out by all the risks that might have been identified during the due diligence. Yeah, so that's it from me. I will hand it back to Sarah and Simon.
Thanks very much, Kanika and Sarah and Ros, who are hopefully back with us on the virtual stage. Hello, both. Just a reminder to those of you that are in attendance, please, if you've got any questions for the guys, just ping them in the chat box. Please ping them in chat, that would be great. But I've got a few questions I'd like to kick off with. I think, firstly, I'd like to ask really, Kanika, Ros, this is over to you. Why do we focus on tech so much? And in terms of due diligence, what are some of the special areas that we look at around technology?
Well, from my perspective, I think we tend to focus on tech. It's an area that a lot of our members are quite comfortable in some ways. So in terms of certainly understanding the potential in the market, also the potential to scale is often much easier because the physical barriers aren't necessarily there. And again, reaching an audience can be easier. At the same time, adoption is sometimes an issue. What I would say is, do I think there are special factors to it? Sometimes I think that we focus quite a lot on the actual tech, and perhaps that isn't as useful as things like market size, as Kanika was saying. You know, a lot of this is about what the market is and the application is. Often solutions that are less than technically perfect or less than well formed, you know, can still get quite a lot of traction. I'm sure we can all think of quite a lot of things that have developed over the years to become much slicker than they were when we first adopted them. And you know, so for quite a lot of that due diligence, at least for me, is actually much more about market size, how driven the team are, and how much traction they already have, and how well defined their audience is. Kanika, I don't know, do you have anything to add?
Yeah, I would just add, so I totally agree with Ros, exactly the same on the due diligence that we do on the tech front. And I just wanted to add that financial perspective almost of why we prefer tech, or I personally prefer tech, right? It's about, if you look at potential for outsized returns, it comes from almost like, you know, monopolistic characteristics of business, which might come from network effects or IP. It could also come from brand, but, you know, network effects, IP is the kind of moat that a good technology business might have around it. And then also it comes to capital efficiency, especially for tech businesses, because you have that moat, either your, you know, pricing would be better, or your cash flow, your return on investment would be higher. And that kind of translates into higher multiple, because, you know, for every additional sale that you make, or every additional customer that you get, it will be a fairly high, it could potentially be a very high margin business and move more to cash flow than requiring constant investment of, you know, working capital or cost of goods sold, etc. So from a financial perspective, you know, tech, that's why you get those higher multiples in some of the tech businesses.
Okay, great, thank you. So Sarah, question for you. When you're thinking around some of the female founders that have successfully raised with us, any commonalities in either them or their business that strike you?
So I think, you know, great communication skills and ability to connect with people, because, you know, that they've got years ahead of them of selling to customers, fundraising, hiring great people. So that ability to communicate and inspire people around them, I think, is a common characteristic to founders. And, you know, if it isn't something that you're born with, these are skills that you can develop. So, you know, you don't have to be alpha female straight out of the traps. You can learn those skills. I think, you know, the right level of openness with investors. You know, you are kind of asking people to commit their hard-earned money that could just as easily be spent on a new car or a holiday or something for the family, to put that money at risk in your business. I think you need to kind of show those investors, you know, some love and respect, and that means kind of sharing the information that we ask for and getting us comfortable with your investment. And then once the investments happen, you know, giving us the information that we need just to know actually everything's going well, or how we can help. I think that just sort of, you know, kind of repeating some of what Kanika was saying, you know, the characteristics of the businesses that do well with the groups are the ones that can scale efficiently. So, you know, angels typically kind of raise relatively small amounts of money. So what are the businesses that will be able to get further faster on that money?
Okay, thanks, Sarah. I would point out, by the way, that no one's allowed to go on holiday or has got anywhere to go in a new car, so they might as well invest that money instead, frankly. But
exactly, yes. Good point.
So, Ros, I'd like to talk about traction a little bit, really in terms of what we think of as traction, particularly in these relatively early stage companies, and why is it so important for companies to be able to demonstrate it to us?
Well, this plays into valuation quite a lot, I would say. So traction for me correlates to risk. So, you know, if you think you know who your customers are, but you don't have any paying customers yet, and you know, there's quite a lot of difference between having beta customers who are doing things on a trial basis and are free, or people you used to work with, you know, those sorts of things, and actually having customers who are paying for your services, whatever those services happen to be. and you know, that's the initial test, I would say, of product market fit, is like, anybody at all willing to pay for this, and can you find them, and can you then persuade them that you are the right people, there isn't an adjacent solution or you know, another solution that's the same that they could be taking instead. And I think, you know, that shows that you've got to a certain point of development of honing whatever your product is, that actually allows, if you like, an investor to have a little bit more confidence. So again, it's kind of, I think for me, some of that is how you move from the friends, families, fools part to angels, where you actually need proof points for people to invest. And I think that's kind of where it's at. Otherwise, for me at least, if there's no traction, I think, oh, it looks like a great product, I can see that you've done your market research, then I would expect a much lower valuation. So effectively, I could buy much more of the company with my small amount of money, if you like, because the risk I would be taking would be significantly higher. And again, it's that sort of thing where, you know, our process prior to pitch actually really helps, because it does filter out some of the businesses that haven't quite got that thinking right yet.
Sure. Okay. Thank you. So is it fair to say on that point then, that, so because I'm being asked this question by founders applying to us all the time, I'm always asked, well, how much traction, how much money should we be making? I mean, that's an open question right at this point.
Yeah, pretty much. I mean, you know, you can't say, well, once you're making £500 a month or £5,000 a month or £50,000 a month, you know, then that makes sense. I think it's a little bit sensitive to, you know, what your product is, what the volumes might be, those sorts of things. It's really hard to tell, isn't it? I couldn't tell if you're selling one piece of software that's £500,000 a month, you know, and you think you've got a customer base of, let's say, I don't know, 20,000 businesses across the world, and nobody else can do this thing you're doing, you know, and you've already got 2 of them, that's amazing. You know, if you're basically doing, let's say, a banking app or a fintech app for consumers, then actually you need much higher traction to be able to demonstrate, if you like, the amount that you're going to need to make a successful business.
And sorry, just jumping in, Ros, what happens if you're a higher stakes and you're still building your biotech business, so you're very much in R&D stage? How would you measure traction?
Yeah, I tend to measure that in sort of moonshot terms. You know, I don't have sufficient knowledge, and I don't think anybody does, unless they can see the future at this point, to really understand, you know, what that looks like. For me, traction looked like other people willing to invest, people that were in the biotech industry willing to go and work there, which actually says a lot, right? Because very few people I know take jobs where they think they're going to be out of a job in 2 months because nobody knows what they're doing. You know, that's quite a big punt. But again, for me, that was reflected in, you know, a smaller investment and, you know, a different sort of valuation to investment gearing than previously hadn't. Obviously, you know, they've just raised a very good round. So far, you know, fingers crossed, we'll be seeing some nice bits of pork belly that, you know.
And they had some very good IP, and we had somebody look at that, spend quite a lot of time evaluating that. So, you know, that's another form of traction, isn't it?
Yeah, it's a way of protecting a part of the market. Yeah, for me, yeah, absolutely.
Okay, Kanika, I wonder if you could talk to some of the things that typically go wrong for startups, and particularly in the early stages, and what are some of the ways that we can anticipate those in due diligence?
Right. So it depends. That's the answer for everything in angel investing, right? So what can typically go wrong? You know, usually companies fail or wrap up when they run out of funding, right? So one of the things to be careful about and to definitely look into is the kind of runway that the company is raising, and what miles will it help them reach. Will it help them reach those milestones, which will enable them to raise their next round of funding, right? Because if they don't raise their next round of funding, the idea may be great, the people may be great, but you know, you don't have money to pay salaries, you don't have money to, you know, you can't continue running the company. You know, people. I guess the very important part of all of this is people, because I've had companies which have, you know, managed through terrible external situations which could not have been anticipated, and it was purely because of just the grit and the determination of the founder, and using all resources possible to raise money, keep going, and just make the thing work. So I guess what you look at, therefore, in the due diligence process is really the team and their grit and determination. Easier said than done, but you make your best judgment on it, right? So.
It's a bit of a cliche, but people say that a great team can pivot into a better market or can improve their product, but you can't do anything to fix the team, can you? So
okay, right, thank you, Kanika and Sarah. So well, our process, I think Melissa's already has asked this question. It's very interesting, and just how it's changed over the years. I mean, we've been doing this 5-6 years now. So as a group, how have we changed? And actually as an individual doing it, how do you get better at it? Ros, why don't you answer that one?
That's a real, how do you get better at it? I genuinely, I would say everything you get better at with practice, right? There's literally nothing on this earth that you don't get better at if you do it more than once, I don't think. So I think our process has changed in the sense we've got more explicitly structured about it. I think now that we are much more, and especially as deal leads, when we start, we're much more blunt about going, please volunteer. If you don't, I will assign you, and actually structuring it in that way. Certainly my experience has been that it's become more consciously that way. And I think that's a good thing, because actually for some people who would naturally not volunteer for things and stand back and think that perhaps their contribution wasn't valuable because it's their first time or their second time, and some of our angel investors are really, really experienced and some are less experienced. I think it encourages more participation that way, and sometimes levers or shoehorns people into doing it even if they don't 100% want to. But I think that's a really good thing, because it's quite easy to just ride along on these, and I really think it's valuable experience. It's enjoyable, you learn a lot. And I do think the only way to get better at it is to actually do the due diligence, I think, and maybe even invest yourself. But at the end of the day, it's not something I don't think you could ever be perfect at, or else you could the only way to be perfect would be to remove the uncertainty, and then it really wouldn't be angel investing anymore. It'd be index-linked units.
No, quite. Kanika, Sarah, have you anything to add to that about how we've changed maybe over the years in terms of approaching DD?
Well, I think as we've been doing it closer to, well, we've been doing it 7 years now, haven't we? So we've got some people who've been doing it for that long, so there's a really deep body of experience within the network, and I think you do just get better with practice, and I think there's nothing like having your own money at risk to make you pay attention. So you've got to do it. You've got to, not just go through the process of due diligence, but then track the company afterwards, read the reports, watch what they're doing, attend the investor update meetings and things like that, because it's not just what you do before investment, but it's how we support, if we can, the investments after we've written that first check.
Sure. Okay. Right. All of you have touched a little bit on valuation, but we've had a couple of questions in already about it, so I think it's worth pushing on, and not least because I'm being asked it all the time by founders. So, Sarah, you already pointed out that that it's not necessarily a core thing that we push on or that we view as something that we're hardcore negotiators about, but really a question to all of you is there a range of valuation? I mean, what is broadly comfortable for us when we're putting a valuation on an early stage company? Kanika, why don't you go for that?
I was unmuting myself. And again, it depends. It depends on the stage, right? So if you're doing pre-seed investing, where you're just at an idea stage, you just have an MVP, the kind of valuation you should expect to demand would be different from if you've moved from that stage and you're raising a seed round or a pre-series A round. So I don't want to give a number, because that number really varies, right? It could vary from 2 million to 10 million, you know, and somewhere in that range for, you know, a pre-seed to Series A. But for founders, I would say look at other companies similar to you that have raised funding and do have that benchmark in mind of what, you know, because all investors look at comparables and comparable investments. So that should give you a good sense of the benchmark of where other companies are at. And it's not just the stage, it's also the sector you're in, or, you know, the kind of business model, so to speak, you might be having, right? So keep that in mind as well. So an early stage biotech company can demand a certain kind of valuation because, you know, it just has so much more growth potential. You know, it could be a 1 billion business someday or whatever. So, you know, that also needs to be kept in mind. So the sector that you are in and the market opportunity you're addressing.
There's also
Sarah, sorry.
I was just going to say there's also a top-down element if you're talking to founders that, you know, how many rounds are they going to need to do? So how much money or how much equity do they need to hold back for the future rounds as well? But, you know, the bottom-up approach has got to make sense as well. So yeah, comparables is the main thing we look at, and comparables in the UK market rather than US market where valuations are completely different.
So sorry, Sarah, picking up on what you're saying there about it being you sort of thinking several rounds ahead is I'm just trying to get that clear in my head there. So are you suggesting then that we don't want to see too low a valuation at the very beginning because we don't want to end up with too small a stake in the company 3 or 4 rounds of funding down the line? Is that right?
Yeah, I mean, we see a lot of that, and I think it's a particular problem with female founders that they've raised way too early. So, you know, I think we need to bootstrap our businesses for as long as possible. So you create some value in the company, and then you can go to investors and actually command a decent valuation to start with. So, you know, avoid raising too early, but also make sure you are getting a decent valuation because, yeah, we see these businesses where the founders are so heavily diluted that actually they're no longer as incentivized as we like to see them to you know, stay the course and make the business grow.
Okay, right, thanks for that. No, that's clear. Question about social impact or sort of general impact businesses, however we regard impact businesses. I mean, clearly there's a great deal of chatter in our world around this, and we are seeing a lot of companies approach us that with an explicit impact mission. Are there implications on how we do due diligence around impact-driven companies? Ros, I'm going to chuck that one at you.
I think that the due diligence should be the same, but the individual investor motivation might be slightly different. So, you know, in the same way that, you know, I was talking about higher stakes being a bit of a sort of moonshot, I think there are elements where you might take a chance on a business you wouldn't otherwise because you think it will make a positive impact. So your risk appetite might change as an individual. But other than that, I think due diligence is still exactly that. You know, you're assessing essentially the risk of putting your money into this venture and whether or not you feel you can trust the management team to deliver what they say they're going to deliver. Whether that is social good or profit for you is almost irrelevant. You know, can they deliver what they promise? Yes, no, is really the answer that I think you're trying to get to.
I always think that if they aren't delivering on their financial objectives, then they probably aren't achieving the impact. You know, we still need them to scale. I think for me, the difference often comes down to, you know, you may appreciate these businesses take a little bit longer. So the risk is to do with the amount of time it takes to see a return, but not that they should be any less ambitious in terms of delivering financial return. My 2 cents worth. But Kanika, you've done quite a few impact investments as well. Did you have a different view?
No, I absolutely agree with what you and Ros said, right? So it may, people's risk appetite may be different and willing to take more risk, you know, especially if it meets the investors' personal goals or what they would like to be backing into with their capital. But it is about financial return, because it is, it is not charity. It is about financial returns. But yes, it could be a longer time frame, as Sarah, you said. But the process is exactly the same in assessing the opportunity.
Okay, great. It's very clear. Thank you.
And I think we had a question in advance that was asking about femtech, wasn't it? Specific sector, and I think the same rules apply. The principles are the same, but in every one of these deals, you'll try and bring in some relevant sector expertise. So that's what changes between different sectors rather than the process itself. Sorry.
No, that's fine. It's a good clarification. Thank you. I was going to ask it, but that's all right. You got there before me. So we've had a couple of questions in about timescale. And again, this is one I get asked by founders all the time, so it'll be a good one. So I guess the blunt question is, it's a pitch event, we've got a whole bunch of people that show interest in the company, we're going to due diligence. How long does it take?
Takes as long as everything in the world takes, which is about 3 months. So, often less, sometimes a little more. And I'm sure, it can be done very quickly, but reasonably speaking, for me, it's always 2 to 3 months, really. Probably closer to 3.
And if there are, that certainly chimes with our experience.
Yeah, we have done quicker than that, but actually the point I usually make is that it's rarely Angel Academy holding up the round being closed. We're normally people with individual angels or funds, so all that money needs to be in place at the same time. We're not going to put the first bit in unless we're sure that the rest of the money is coming. That's an easy way for us to lose money if the rest of the money isn't committed.
What's the quickest we turned it around then ever, Sarah, that you know of?
I think we've done one in 3 or 4 weeks. And a lot of it depends on how organized the founder is. If the founder has all that information available in a data room that we can review, it's up to us, but quite often we're waiting on information to be ready. It's often the legals actually that take quite a long time because they go back and forwards between several different people.
And the longest we've ever taken?
We try to sort of cut it off before it officially put something on hold if it's not going to happen straight away. So we've done that a couple of times. If a founder, they have some money on the table from us but can't find the rest of the round, they quite often decide to sort of have a pause and go back and focus on their business. So I don't think it's that we let it drag on indefinitely. It's just timing is everything.
Great. Okay, so it's Ros's answer then. 3 months. Just 3 months. That's what I'm going to tell them from now on. Oh, it takes 3 months. It doesn't matter. No matter what you think, it's going to take that long. Like a friend of mine once said, all journeys in London, 1 hour, even if it's just down the chip shop. It's 1 hour. Right. Red flags. I love this question. It comes up every time. I want all of you to answer this in turn. What are some of the key red flags for you individually when you're doing due diligence? Because I know this does clearly, I think, differ with different risk appetites and different investors. Ros. Well, Kanika.
Yeah, go on, Kanika. Kanika can go first.
Oh, okay. So I think for me, a red flag would be consistency in answer. So I personally like to see authenticity and honesty. So if a founder doesn't know the answer or hasn't thought about it, I'd rather they say, okay, there's something to think about, but we haven't, rather than give you an airbrushed answer. So that's a red flag for me personally. Second is in your financial projections, when you see the hockey stick, and we see hockey stick from everyone, that's fine. You expect to see hockey stick, but there's some delusional models out there that's a red flag for me. If you can't even think through the drivers of your business a little more realistically, of how will you achieve those sales, and how will you get that cost of customer acquisition down, etc. So not understanding the drivers of what could potentially be the financial drivers of your business is also red flag for me.
Yeah, so
Ros, you're at a moment now. Come on, what are your red flags?
People, always people. Those are the key things. That I like to think I'm quite tolerant of lots of things. And some stuff which is, I wouldn't say it's a red flag, but where you just go, you know what, that just doesn't make sense to me, or I can't see the case, or there are particular areas you might not invest in. That, I mean, for me, largely it's people. It's anything that's a bit duplicitous, or founders that don't appear to want to consider other ways of doing things or options. It's not even, you don't actually want people to just slavishly follow your advice, but you do want them to at least consider it in a meaningful way. And it's those sorts of elements, where I find things very difficult, and certainly that has caused me to back out of more than one deal. And the other thing, just my personal thing, family members, don't like family members in a business, just from multiple experiences working with family members and those sorts of things. It's just a risk factor that's really impossible to manage.
Does that include, and I'm no particular reason for asking this, but in all seriousness, we have invested as a group, as it happens, in quite a few companies founded by couples. So does your reservation around family members extend to that?
Yeah, especially that, actually.
Especially that, good.
That,
good.
Parents and children, yeah. I mean, uncles and aunts and that sort of thing, it's different. But yeah, married, I don't think I'm in any businesses that have a married couple running them anymore. Yeah.
No, it's interesting. No, okay. What about for you, Sarah? Dare I ask you your red flag question?
Married couples aren't a red flag for me as a
That's good to know. Good.
as a co-founder with my husband. I suppose, yeah, I mean, I just kind of a bit more of what Kanika and Ros are saying, that people that aren't very open about their businesses and kind of aren't willing to share the challenges, and it's just these very sort of glossy stories, or just don't understand why we might need some quite detailed information when we're making our investment decisions. So you just get the feeling that all they want is your money and nothing else, for you to leave them alone and let them have an easy life, and that's not really angel investing.
No, not really. Okay, thank you. Right, I want to talk about financial projections. How much? So, sorry, winding it back, bearing in mind a lot of companies that come to us that go into due diligence are relatively early stage and maybe many years out from anything looking like an exit. How much detail do you think it's reasonable to look for in projections? I mean, Kanika, you've already touched on the mythical, and in my case, much hated hockey stick graph, but how much detail do you think it's fair to look for in DD at this stage?
So for me personally, if it's very early stage, I'm not looking for precision in the financial model or anything beyond 3 years out. So I think, as Sarah said, for 1 year out, it's important, especially to have control on your costs, right? Because you're raising money and you're raising a runway. So it's about cash flow, and will you even get to the end of the year or end of 18 months? But I would like for founders who are at the right stage to have thought through some of the drivers of the business. And then, if you model out your business, you may not get precise numbers, but it'll tell you something, and, to keep in mind about how you plan for it. So I think how they think about the drivers, and therefore what the takeaways and how they plan for their business, is more important than the precision of the numbers, because the numbers are going to be wrong. That's the one thing, going in looking at the numbers, is they're going to be wrong. So yeah, not more than 3 years out necessary, and too many drivers, too much false precision is useless. If a simple model should work just fine at an early stage.
And then I think that what we're what we're looking for is companies that get better at doing their forecast each year, each investment round as well. You know, that they've learned from the previous mistakes, they've changed their assumptions, whatever changes they need to make in the business to be better at forecasting. I think that's important, that they're learning as well as us.
Ros, do you what are your requirements, projections wise?
I don't have very much to add really. I think one of the key things is founders being able to show that they understand where they are, what they've spent so far, you know, well, and clearly have a good method of capturing that. It's not just all a bit of guesswork. And then, you know, essentially 100% what Kanika and Sarah have said, not necessarily modelling it to the nth degree, having a really good grasp on the near future and meeting their targets and getting better at, you know, setting those goals. All great.
Well, we all know where too much modelling can get us, don't we? Question about the and that actually really relates to the timescales, the 3-month answer, but a bit more detail on that is how many meetings, and I'm guessing in this case I'm going to go meetings in quote marks, but we all know what we mean by that now. Is it reasonable to expect with the founder during this process?
So if I take that, so the 12 weeks sort of is it 3 months is a little bit facetious, you know. Reasonably given, it depends. All the answers are it depends very much, but it will be a number of meetings with the founders to discuss. You know, it depends on how good the information is in their data room, how many questions we have. You might have different meetings on different topics. So, for example, you might meet, let's say, the CFO, the founder, the tech team. You might meet them all separately or all together several times, and some CEOs will never let their people talk without them present, which, you know, always concerns me very slightly. If you can't trust your CFO to be out on their own, you've really got some problems. But yeah, I mean, so I'd say there isn't really any particular number, but normally I'd expect to be talking to them at least 3 or 4 times as a group through the process, and I'd expect the deal lead to be talking to them probably quite frequently to update them and just, you know, keep in touch.
And as we're a year into this particular crisis, then how has the virtuality of it all changed?
I think, I mean, we always used to do a lot of due diligence virtually anyway. I think the biggest change is the pitch events being online. And there was definitely this kind of myth existed with investors. You can't possibly invest in somebody that you haven't met personally. But actually, one of the things that has worked this year is that you know, when we're doing due diligence, it's small teams of people, and actually you can build relationships on Zoom. Thank God for Zoom and other technologies. So, you know, it actually is possible, isn't it? I mean, yeah, I think the biggest change for us has been around the pitch events, and that, you know, nobody's in a room together. So
okay, great. Well, look, I'm aware that we've basically got less than a minute left, but with that in mind, I do want to ask you all before we go, just for one top due diligence tip each. Go on, you're on screen, Sarah. Give us your top tip for due diligence.
Oh God, I haven't had any time to think about it. Top tip is, well, you know, do as much as you can. The more you do, the more you learn, the better you become for future rounds, and, you know, give it a go.
Kanika, top tip? Yeah, Sarah stole my tip. Learn by doing. Sorry. Learn by doing. That's my tip. Yeah.
Go on, Ros.
So mine is just, you know, your contribution is worth more than you probably think it is, which is pretty much what I always say, and to a degree echoes what the others have said.
Fabulous. That's a lovely positive note to end on. I love it.
At all, is it?
Right, okay, well, look, firstly, let me say thank you very much to the panelists. So well done, guys. I'm clapping on behalf of everyone else that's on the call. So just to say, we have recorded this session. As you can see, it's bleeping recording. We'll endeavour to get that uploaded this evening, and we'll let everyone know in an email. Please tell other people about it. For those that couldn't attend, I'm sure they'll get something out of it. In general, as ever, follow us on our various social outlets, specifically LinkedIn and Twitter. If you haven't already, I'm sure you have, but do sign up for our newsletter. Check out the website and blog on Medium all the time. There's always new content there. Applications are currently open for our June pitch event. We are currently screening for those. So if you know willing and hungry founders, do send them our way for the June event and get them to apply via our website. And finally, we'll be doing another one of these Investor Academy sessions in May, on May 18th, I believe. But we will, of course, be in touch about that nearer the time. So that's it for now. Thank you very much again to the panelists. Thank you to all of you that could make it this afternoon. And we're going to let you get on with your Thursday evening. I hope everyone has a great one. All right. Thanks, everyone. Bye.
Thanks, Simon.